stock market is clearly the US. And the most obvious reason why is because 29.4% of their market is technology sector, plus another 9.1% in telecommunication services. So effectively, they've got 40% of their market exposed to technology stocks. And our market is 25% banks, which have got almost no earnings growth, and 25% resources, which are very cyclical. They can have great years and bad years, and a bunch of rather boring old industrials, which includes a big lump of real estate investment trusts, which are low, no growth. So we've got a very dull economy compared to the US, and 40% of theirs is based on technology stocks, which have much more earnings growth than our market. So if you look at a chart of the Australian market relative to the US market, the performance of the All Ordinaries relative to the S&P 500 has been relentlessly the All Ords underperforming the S&P 500. Except for a couple of moments. And the time Australia outperforms the US is when the US market falls over, and that is in the 87 crash and the tech wreck. The other time the Australian market outperforms is when tech falls over, which it did in 2002. The NASDAQ fell 37.7% in 2002, so we outperformed. But you wouldn't buy Australia because tech falls over or there's a crash or there's a tech wreck, because you just lose money less fast. It might outperform, but it's not worth being in the Australian market. It's not worth being in equities at all. So when is it worth being in Australia relative to the US? There's only been one time in the last 30 or 40 years that it's been worth investing in Australia, and that was during the resources boom from 2000 to 2008. When the whole world's attention turned to Australia and Canada, which are two resources-based stock markets, where you could buy BHP, Rio, Fortescue, and not only did you get share price rises because China's building Brisbane every 3 months, not only did you get share price rises, but the Canadian dollar, the Aussie dollar are both commodity currencies, so the currency was going up as well. So you bought BHP, you made money on BHP, and you also made money on the currency, which went, if you remember, to $1.10 relative to the US dollar during those 8 years. So if we have another resources boom, then Australia, or the world's attention will turn to Australia again. It'll be fantastic. Hopefully there's one before I retire. Because that is one of the most spectacular money-making opportunities in Australia when there's a resources boom. At the moment, with Chinese economy flailing along, trying to patch holes in their property market, there's no resources boom happening. So that's the only time the Australian market will outperform. Other than that, we still have this relentless growth in big tech stocks, especially now AI is driving earnings as well. And all the action is in the US. So the Australian market is going to continue to underperform the US until big tech sentiment turns for the worst, or until there's a resources boom. There's no sign of either of those things happening at the moment, which is probably why our strategy portfolio has no exposure to the ASX 200, to Australia. We've got 80% in FANG, NASDAQ and S&P 500 in exchange traded funds. And I can see no reason to invest in Australia relative to the US at the moment. Thank God for ETFs, which allows us to do that. And I can't see us changing those settings for a while.